Hello. Today we are going to discuss about the withholding tax provisions and treaty benefits, that is double taxation avoidance agreements India has entered with around 90 countries. So let us first discuss what is the situation if you don't take the benefit of DTAA. Then Indian payer will deduct 20% plus surcharge plus cess while making payment to you. Now, in order to avoid that is a huge amount of tax deduction, and then it will take around 24 to 36 months to claim the refund. In place of that, we have the provisions of DTAA, which provides you a right to get a lower tax deducted at source. And there are 94 countries, as I have mentioned just, that this provision is there where you can take the advantage. So let us go deeper into the subject. I am Abhinarayan Mishra. I am a chartered accountant by profession based in Delhi. Dwarka is my office. And so let us discuss one by one about the provisions of this. So first of all, I am just starting with an example. Let us say there is an Indian company which pays to the US company, that is a US vendor, and deducts a tax of 20% plus cess and this surcharge. So the company will be paying Indian company will be paying only around 79.2 lakhs in place of 1 crore, and the treaty provisions, if it would have been applied, so then it would have been rate would have been 10 to 15%, so potential saving of 10 lakh to 11 lakh per transactions. So this under section 92 subsection 2, you have the statutory right. If DTA provisions are more favorable to you than the income tax provision, then DTAA shall prevail. So it is mandatory, not optional. When TT rate applies, surcharge and cess are not levied additionally. That saves around 6 to 10% of effective tax. Income Tax Act, which is going to be implemented from 1st April 2026, also preserves the same provision with numbered maybe different. So withholding tax rates are rates of and ITA, Income Tax Act, provides certain categories where you can see the potential saving. So let us say under the dividend, the rate is income tax rate is 20% plus surcharge and plus cess, and under the India US you will get 15%. You can get the deduction 15%. India UK is 15%, but the India Singapore is 10%. India UAE is again 10 to 12%. Interest the same, almost same rate is there. Royalty almost same rate is there. FTS is again almost from 20% to 10%. And capital gains tax is as per the domestic law under the Income Tax Act, as well as in India USA and the India UK law. But the India Singapore and India UAE has some exemptions there. Going forward, let us say you want to claim this TT tax provision. So what are the documents you need to provide? There are 3 documents. One is TRC, then second is Form 10F, and third is no PE declaration. Now, what is TRC? TRC is the tax residency certificate. This is the official certificate from the foreign country's tax authority, and it has to be obtained mandatorily under section 90/4, subsection 4. And before making the first payment, Indian payers, before getting deduct, you must obtain this with, be careful, your name, status, tax identification number, residential address and period of residency must be mentioned on that. If not, any of these things are missing, then you have to comply with the additional requirement, which I am going to discuss further. If you are, let us say, in the Middle East, in the UAE basically, then you have to apply via the UAE Ministry of Finance portfolio, which is valid for the financial year only. So for all TRC, be careful, it is only for specific financial year only. Then there is another form 10F. That is a self-declaration form as required under section 19 subsection 5, and it is if any of the particulars is missing in the TRC, then you need to file this, and this is again annual filing. It is not a blanket certificate, and for each income category you need to file it, and it is filed mandatorily under the online system. Then third document is no PE declaration. So in case of PEs in India, then treaty provisions do not apply and domestic rates will apply. So you obtain written no PE declaration from the foreign entity before every cross border transactions. When the PE triggers, so let us say fixed place of business is there and dependent agents are, and the construction projects 6 to 9 months is there. So this no PE declaration is the first line of defense you have before getting any scrutiny from the income tax department. Besides the three documents, India has strengthened its anti-abuse framework under the 3-4 category. One is MLI, second is GAAR, then PPT, and finally beneficial ownership. Now this MLI is a multilateral instrument and it is effective from 1st April 2020, and it covers all tax treaties, almost all tax treaties. Under this, the principal purpose test, that is PPT test, is carried out. So benefit will be denied to you if obtaining treaty benefit is the only purpose you have, that is the principal purpose of your arrangement. And then there is a limitation of benefit, that is LOB test. So there are certain entities only for whom this benefit will be available. Then there is a super powerful topmost provision, that is GAAR, GAAR, General Anti-Avoidance Rules, under section 95 to 102 IT Income Tax Act. So any arrangement is impermissible if the main purpose is to obtain tax benefit only and it lacks the commercial substance or treaty provisions are misused. So GAAR overrides DTAA as DTAA overrides income tax. And however, the GAAR applies only if the tax benefit exceeds 3 crore. If you look at India-Oman protocol signed in June 2025, or most modern treaties now include explicit PPT article. PPT plus GAAR can be applied simultaneously. Then another provision is beneficial ownership and conduit test. So under article 10, 12, 11 and 12 of DTAA, this beneficial ownership test is conducted. So TT benefit is applied to available to beneficial only. It is not available to a conduit company that merely routes payments through some structuring, like routing the fund from Mauritius, Singapore or Netherlands with zero substance only for TT benefits. The CBDT as well as the Indian courts have consistently denied the treaty benefits. And then is a substance requirement. So board meeting in treaty country, key decisions made there, local employees and office, all must be documented properly. Then we have let us look at the MFN clauses that most favored nation development between 2023 to 26. So MFN clause, India grants a most favorable treaty rate to a third country. The same rate applies to MFN partner. Now, post Nestle Supreme Court ruling in 2023, MFN benefits require the formal Indian government notification under section 90. They do not operate automatically. Switzerland, and the fallout of this is Switzerland suspended MFN clause, MFN benefits from January 2025, citing this ruling. If you look at 2024, March 2024, we had India, Spain, this government notified MFN and government notified MFN clause that 10% rate on royalties in FTS, and they similar benefit had been granted to India-Germany treaty. So Spain-based entities now pay 10% via versus 20% domestic default rate. Then in June 2025, we had India-Oman protocol where the royalty and FTS rate was cut from 15% to 10%. And just we have mentioned that Switzerland suspended unilateral MFN application after Nestle Supreme Court ruling, and dividend withholding from Swiss entities rises from 5% to 10%. So what is the planning strategy we should have? So first of all, treaty selection and legitimate treaty shopping. Now see, treaty shopping is a negative connotation, has a negative connotation, but here we are discussing the legitimate way. So you structure your holding company in treaty-friendly jurisdictions with genuine substance like board meetings and decisions and employees, so that you can have a proper advantage of that jurisdiction, like Singapore, 10% royalties there, or Netherlands, UAE. So they are the viable options. Second is income characterization arbitrage. So if you characterize, that is classify and properly characterize your income, then you can take the treaty benefits. Like software payment can be covered under royalty, Article 12, or applies, or business profits under Article 7, where WHT only if the PE is there. So getting this right upfront avoids costly recharacterization in assessments. Then the MFN clause monitoring. So you must track the Government of India's MFN notification, because unless you have the notification, you don't get any benefits, treaty benefits. Then another option, and that is also workable, is a lower withholding tax certificate. You file Form 13 under Section 195(3) or 197 for nil or lower TDS certificate before the transaction. Avoid cash flow strain by paying 20% plus upfront and then waiting 18 to 20%, 24 months. Then another option is APA and MAP for recurring related party transactions. Let us say if you have the related party transaction on a regular basis for high value recurring payments, so consider a bilateral advance pricing agreement, and that gives certainty on TP and withholding tax characterization. For disputes, use mutual agreement procedure MAP under the treaty. So what is the pitfall you should avoid? Avoid writing any missing information. You must write in detail a specific on TRC. TRC must not have expired. Be careful. It has to be obtained before the first payment and every financial year. Then missing Form 10F. 10F is an annual and income specific type specific, not a blatant certificate. So many non-residents often file one and forget. The Indian payers then will deduct at full rate, and so AO proceedings will happen subsequently. And then another pitfall you should avoid is undetected PE creation. Single employee working regularly from India or agent routinely concluding contracts is a PE. Once PE is established, your past year's benefits of tax treaty will be denied, retrospectively that is. And then post MLI and GAAR, routing payments through a holding a company with no employees, office or board meetings is a treaty denial territory. So AO applies PPT and GAAR simultaneously. So substance is now non-negotiable. And then last is the warning PAN non-compliance. You must comply, although some relaxation is there for PAN to come, but you must comply with that. So if you then checklist we are going to discuss just a few minutes. So identify correct DTAA article, then verify TT rate and more beneficial than Income Tax Act, then obtain valid TRC covering the financial year, check if 10F is required, and obtain no BE declaration, run GAAR and PPT check. Genuine commercial substance must be in treaty country, and the monitor MFN notification. For large payments, you may consider filing form 13 for lower TDS certificates. So if you like, this was all about today's presentation. If you like my presentation, you may subscribe my YouTube channel, and looking forward to more discussions and with you. Thank you.